In a single week, 7 of the most powerful companies in American history lost more than $2 trillion in market value. No scandal, no bankruptcy, no fraud. Just one announcement from the White House. The Magnificent Seven, Apple, Microsoft, Amazon, Alphabet, Meta, Nvidia, and Tesla, had been the engines of the American stock market for years. They survived COVID, rising interest rates, and the AI investment boom. But in early 2026, President Trump's sweeping tariff agenda sent all 7 into a bear market simultaneously, a historic event that wiped over $2 trillion from their combined value within days of announcement. This is the story of how trade policy became the biggest threat to big tech and what it means for your portfolio. When Trump announced his reciprocal tariff policy, markets responded with immediate panic. The Nasdaq posted its worst single trading session since 2020. Tesla and Nvidia fell as much as 10% and 8% respectively in a single day. Apple, which makes 90% of its iPhones in China, shed nearly 8%. The cumulative market cap loss in those first 72 hours crossed $5.4 trillion across the broader market. Why did tech get hit so hard? Here's the number Wall Street kept coming back to. Roughly 50% of the Magnificent Seven's earnings come from outside the United States. That's higher than the S&P 500 average of 41%. A global trade war hits them harder than almost any other sector. Apple was the biggest casualty. With its deep manufacturing dependency on China and Taiwan, the company shed over $770 billion in market cap in the first days. Analysts warned that a 15% to 20% increase in Apple's manufacturing costs could flow directly into either consumer prices or margin compression, neither of which investors wanted to hear. Nvidia faced a different but equally serious threat. Semiconductors are at the center of the trade war, and while chips were initially exempt from some tariffs, targeted chip tariffs were signaled as coming. For a company that had 70% of its revenue coming from abroad in 2023, the exposure was enormous. Tesla, already facing a decline in consumer demand and multiple Cybertruck recalls, saw its stock hammered as EV components sourced from outside the US became more expensive overnight. And Amazon's analysts at Goldman Sachs warned of a $5 to $10 billion annualized operating profit hit from higher merchandise costs alone. Here's what the tariff crisis exposed. The biggest tech companies in the world had built their empires on global supply chains, cheap manufacturing in Asia, growing consumer markets in Europe and China, and a regulatory environment that assumed free trade would be permanent. That assumption turned out to be fragile. Microsoft held up best among the 7 because its revenue is more insulated. Enterprise software and cloud contracts aren't subject to import tariffs the same way hardware is. That's an important lesson. Revenue quality matters as much as revenue size. The Magnificent Seven's tariff crash is a masterclass in geopolitical risk, the risk that laws, policies, and trade relationships can change overnight and undo years of carefully built competitive advantage. Diversification isn't just about stocks and bonds, it's about understanding which businesses are most exposed to government decisions they can't control. This is The Capital. Subscribe for more stories about how money, power, and politics shape the world's biggest businesses.